If you're a physician and you're maybe a little surprised at how much money you're paying in taxes every year to the federal and/or state government, this video is for you. Today, we're going to highlight 7 strategies that physicians should consider when thinking about their overall tax planning and how that pertains to their overall financial plans. One of the common things I think that a lot of doctors miss when they're first starting out, or even later or mid into their career, is just how much money they pay in taxes and the variety of different strategies that are available to reduce that tax bill over time while simultaneously building wealth as they progress through their career. So first and foremost, I think it's important to realize that there's no tax strategy or kind of tax plan that's a one-size-fits-all structure or approach. Everyone's financial situation is very different from another's, and even the colleague sitting next to you with the exact same experience professionally, their financial situation is likely very different from your own. An important thing to just keep in mind is that whatever structures or tax situation you have is likely unique to you, and so whatever planning elements or ideas or strategies we implement also needs to be specific to you as well. When it comes to saving on taxes, I think it's good to always hit the low-hanging fruit first, right? For most physicians, one of the easiest ways for them to save on taxes in the present day, while simultaneously building wealth for the future, is to take advantage of any retirement plan options they might have available through work. Again, everyone's situation is going to be slightly different, but if you're at a large hospital, there's likely some combination of a 401k, 403b, 401a, or a 457b plan available to you through your employer. And more or less, while the machinations of each of those plans might differ, we'll kind of cover that in a different video. By and large, the general idea or strategy to be implemented is taking money that you've earned today, putting it into those accounts, either in the form of a pre-tax contribution or a Roth contribution, investing those proceeds over time, allowing them to grow, and then withdrawing those funds in retirement to support your lifestyle whenever you retire. So where does the tax advantage come from with these plans? Well, the nature of most physicians' practices, or their income specifically, is that you more or less go from all of your training, whether it's med school, residency, fellowship, whatever those kind of lower earning years might be, suddenly you flip the switch, are full attending, and you're making somewhere in the mid to high 6 figures in an income every year. Certainly it's a good thing to have a high income. That's not a bad thing, I would say, by any means, but the trade-off in having a higher income is that under the nature of our tax system, you start to pay more in taxes as you reach higher brackets on every dollar that you earn. And so the strategy or idea of funding retirement accounts is really twofold. Number one, you're putting away money potentially pre-tax. You can either do it as a Roth or pre-tax. Lots of discussion, and certainly it's a very situational discussion as to which one makes maybe more sense for you. But a lot of physicians consider pre-tax contributions just because the idea is you're putting money into your retirement accounts today when you're paying the highest percentage in taxes potentially you ever will. And then in retirement, you'll take that money out, likely in a lower tax bracket, to then pay money on it and income taxes on the withdrawals. It's kind of like a tax arbitrage, if you will. So again, whether it is a 401k, 403b, 401a, or 457b, putting money in pre-tax can be really beneficial because you get that tax benefit today. All the money that you're putting into the plan is essentially not technically deductible, but it reduces your taxable income for that year that you're making those contributions, thereby saving you taxes in the present day. If you're a solo practitioner, kind of a cousin to a lot of these plans is what's called a solo 401k. Very similar premise in that you're setting up investment accounts that act as a 401k. You can put money in pre-tax if that makes sense for your situation, and then take that money out later in a lower tax bracket, again, paying taxes on that withdrawal, but likely doing so in a lower bracket. Another strategy that a lot of physicians find attractive for saving taxes both in the present day and in the future potentially is what's called a health savings account, which sounds like a savings account you might have at a bank, for example, but really what it can be is an investment account that you're used or dedicating solely for retirement planning purposes, specifically healthcare purposes or expenses in retirement. A lot of people will contribute money to an HSA or health savings account and then withdraw the money in the same year to reimburse themselves or pay for medical expenses that might come along, or certain expenses that are deemed health savings account reimbursable by the IRS. An alternative strategy that we work on for a lot of clients is taking the contributions they make to an HSA, instead investing those funds, and then holding that account over long periods of time and essentially treating it like a dedicated healthcare retirement account. I've done a whole separate video on this. I'll try to put it somewhere on the screen if you're curious, but It's really a really powerful strategy in that you are able to deduct any of the contributions you make in the current year, which if you're, in the high six figures, that can be a pretty significant tax savings in the present year. Number two, the funds can be invested within the account and grow tax-free and accumulate over time, similar to how you would in a retirement account, like again, your 403b, your 401a, or what have you. And lastly, you can withdraw money from the HSA essentially down the road to reimburse yourself for healthcare expenses. And so for a lot of physicians who are looking at, I want to retire at 55 or I want to retire at 60, the element that often gets overlooked is just that you're essentially trying to fund yourself for a 5, maybe 10-year gap before Medicare kicks in and your healthcare costs drop as a result. So you might be paying, in the current year, maybe $25,000, $30,000 for a married couple for health insurance premiums alone. And so obviously that can be very expensive. An HSA can be a really beneficial account for those kind of individuals who are looking at that kind of earlier retirement, physician households especially, looking at early retirements and using an HSA to supplement as that dedicated healthcare retirement account. A really powerful tax planning tool. The last kind of retirement plan strategy for saving on taxes is less so a tax savings tool for the present day and more so one for the long term. It's what's called a backdoor Roth IRA. Essentially, most physicians are limited in that they make too much money each year, or their household does, to contribute directly to a Roth IRA account. Roth IRA, for a reminder, is an account you put money into. You're typically capped at, in 2025, it's $7,000. It's indexed for inflation each year. You're limited in putting, $7,000 this year into that account, $14,000 total for spouses. And so the challenge is that certainly doesn't sound a ton of money, perhaps, when you think about it in the grand scheme of maxing out all these various retirement plans. But when done over a long period of time, that amount can really compound. And the bigger benefit of a Roth IRA is that it's all post-tax dollars. So you put the money into the account, it grows tax-free without any kind of tax impact to you in the present year. And then when you go to pull the funds out in retirement, it's not taxable either. So it can be a really powerful tool from kind of that tax planning perspective. The challenge that physician households run into, though, is that they make too much money to contribute directly to a Roth IRA. So there's a strategy of what's called a backdoor Roth IRA contribution, wherein you put money into first a traditional IRA, convert the funds from that IRA to a Roth IRA, and then invest the proceeds. And if implemented over 10, 20, 25, 30 years for a physician household, can be incredibly impactful over time. The second tax strategy I think is really impactful for physicians to consider is what we call tax efficient investing overall. Certainly retirement plan contributions would fall within that bucket, I would say, or certainly be a close cousin of it. But I think tax efficient investing in general looks more specifically largely at your taxable accounts, i.e. joint brokerage accounts that maybe two spouses might have or an individual might have. The nature of these accounts is such that effectively you're able to put money into the account in any amount that you want. You can invest the funds within the account, but as the investments generate dividends or interest or any kind of capital gains, whether they be short-term or long-term, all of those transactions have tax implications in the year that they occur. And so for physicians, these are really attractive accounts to kind of offer like a middle ground between a retirement account over here, maybe your cash on the other hand. Call that like a spectrum of liquidity for doctors. A taxable brokerage account kind of falls within the middle of that. It can be really advantageous for, again, whether using it as kind of a hybrid between retirement planning and even maybe near-term expenses that you're kind of saving or investing towards. The catch, as I mentioned with a taxable brokerage account, though, is a few different things. Number one, any transactions that are occurring within the account could potentially have tax implications for you in the present day. For example, if you sell a stock for a gain, there's potentially either a short-term or long-term capital gain, or maybe a stock or an ETF generates interest or dividends for you. That income might be taxable at your ordinary income rate, which is relatively high right now, maybe relative to what it will be in the future. And so I bring this up to point out a few adages or concepts I like to keep in mind. First and foremost is trying to avoid a lot of those short-term capital gains. Again, they're typically taxed similar to your ordinary income that you're making from your job, which is in a high tax bracket. So why would we add on more income in that high tax bracket? Some physicians are taxed on some of their income, not all, but some of their income at 35, 37%. We'd ideally like to avoid that if possible, and so avoiding short-term capital gains is a good way to do that. The next one is seeking out municipal bonds, specifically for fixed income exposure within the market. The reason that is attractive potentially for physicians It's just that the income from a lot of those investments is tax-free, at least at the federal level and sometimes even at the state level. So the yield on a bond, for example, a municipal bond, might be lower as a percentage of the bond itself. Maybe it's 2%, well, relative to 5 or 6% you might be able to get on other investment options. But I always introduce or kind of remind the concept of what we call tax equivalent yield, which essentially means that if you are on a really high tax bracket, it can actually be a better net yield to you if the investment is tax-free than one that has a higher yield but is taxable to you. There's lots of calculators to kind of look this up. You can plug in your income, the state that you live in. If you Google tax equivalent yield calculator, it's kind of a good way to figure that out as to which one might make better sense for you. But again, just seeking out higher yields relative to your tax situation, I think is a really advantageous approach and an important strategy to keep in mind. The last one, I think when it comes to tax efficient investing, specifically for taxable accounts, is what we call tax loss harvesting. And this isn't always a strategy that actually even makes sense to do, but when it does make sense, it can be really impactful for your overall tax situation, both in the present year and potentially even in later years to come. The very simple concept of tax loss harvesting is essentially taking some investment you purchased, selling it for a loss, reinvesting those proceeds into a different security or a different investment, and then allowing that investment to grow over time, while simultaneously having taken advantage of locking in that loss you realized. The net benefit essentially is that you can then take whatever that loss was and use it to offset gains in the future, or write off up to a very relatively small amount on your tax return against your ordinary income for those losses that you realized. In situations where markets are really volatile, this can be a pretty decent strategy to consider. Again, it has to be the right fit, but it becomes very impactful and I would say much more appealing or attractive for those individuals who are in higher income tax brackets, just again because they have more potential tax savings. Even if we're just writing it off against your ordinary income, that alone can be a decent tax savings for sure. So the third overall strategy is what we call income management. Basically, the idea is trying to time our income as best we can to keep it within certain years to then ideally keep ourselves in lower tax brackets. This one's a little trickier to do, especially if you are an employee of a large hospital. Probably not a lot of bargaining power or ability to push certain bonuses when those are realized or recognized or when you're receiving them. For those in maybe smaller practices, certainly this could be more appealing. If you have a really, really good year production-wise and have hit a lot of RVUs, maybe you are able to push a bonus into the next year or at least have that conversation. Certainly this one goes without saying that you want to consult with any kind of tax accountant or tax professional or anyone who's handling the books for the business to make sure this is all done legitimately. But certainly I think it's something that's worth considering when you think about receiving large amounts or lump sum amounts. Kind of trying to time when those occur can be very advantageous. The fifth overall strategy I think that a lot of physicians should at least consider in trying to mitigate taxes is charitable contributions. If this is something that's important to you, if you donate to your local church or local charity that you really like, or some other philanthropic cause that's important to you, there's a lot of different ways to go about doing that to actually give yourself a decent tax impact in doing so. It's important to remember, if you're just giving cash to a charity each month or each year, there's absolutely nothing wrong with that, but there's a decent chance that you're actually not really receiving much of any tax benefit. One of the tax strategies we really like to look at for charitable gifting, specifically for doctors, it's what's called a donor advised fund, or a DAF for short. The basic idea is this: if I give $1,000 a month to my favorite charitable organization that I support, that basically tallies up to $12,000 per year. And if I'm doing that, let's say 3 years in a row, that's $12,000, $24,000, $36,000 I have gifted to that charity, which is fantastic. The challenge, though, is that, like I mentioned, if you're giving to charities, the tax impacts you really start to realize or recognize for your personal balance sheet is once you are gifting such that the amount you have gifted in combination with other deductions on your taxes pushes you into an itemized deduction status, if you will, i.e. you're no longer taking the standard deduction amount. And really, that's a combination of a few specific deductions, charitable contributions being one of them. What can make sense to do to get you into that itemized category is what's called bunching contributions into a donor-advised fund. The first idea is essentially that rather than in our previous example giving $36,000 over a 3-year span, instead we lump sum gift or contribute $36,000 for that full 3-year period into a donor advised fund. The funds are then invested, typically very conservatively, and then distributed over time out of the fund to your charity of choice. The benefit to you being that you get that $36,000 deduction essentially in that 1 year, potentially pushing you into itemized deduction territory, if you will. Again, this is a very specific planning strategy and it takes a lot of kind of comparison and analysis just to make sure that it's a good fit for you. But in instances where it does make sense to do, for physicians, it could be hugely impactful. You're going from whatever the standard deduction amount might be to tens of additional thousands of dollars in deductions you could potentially take advantage of. The added bonus of a DAF, in addition, is that you don't just have to give cash to the fund itself. You can also gift securities or investments that you might hold. So for example, if you bought stock 20 years ago and you own it for $1 and it's trading at $400 per share, rather than selling the stock and realizing that gain, that long-term capital gain, you can instead donate the stock itself to the DAF, effectively eliminating any kind of capital gained for that contribution. You then get the benefit again of having made the contribution in whatever dollar amount you contributed for in the form of those shares. The DAF then sells the positions that you might have. They can then distribute them to the charities that you like, again, fulfilling your kind of charitable objective while also providing you a tax benefit on the side. It's a kind of a niche strategy, but can make a ton of sense in very specific circumstances. The sixth strategy that I think physicians at least should maybe consider is investing in real estate. It doesn't have to be necessarily anything grandiose by any means, but there are certain tax benefits of directly owning or having some sort of a limited partnership interest in real estate investments, just purely for the tax benefits that they can generate, in addition to maybe income or a price appreciation on the asset itself. If you are a member of a group, for example, and there's the opportunity to purchase the building that your practice is currently renting or that currently already owns and you have the opportunity to buy into, that can be a very attractive option to consider. Again, because you're able to take advantage of the appreciation that's occurring on the property that's kicked back to you as a partner or a part owner. Additionally, if the building entity itself is kicking off losses, that's potentially a tax benefit to you as well. Not to mention that a lot of real estate can be just attractive investments as well, and it potentially diversifies you out of maybe purely being invested in the stock market or only in a retirement account, for example. Real estate investment in general, I find personally, tends to come with a little more risk. You don't see that risk maybe as readily because the price of a piece of real estate isn't publicly traded or published every single day, every single second of the day. And typically real estate also relies on some form of debt. And I think anytime that you are leveraging, i.e. taking on debt to invest, certainly there is heightened risk within that investment as well. That being said, there are certain advantages to it, and I think it's one that a lot of physicians can take advantage of and certainly should consider as well, just purely even for that tax benefit, but certainly additionally for the investment benefits as well. So the seventh and final kind of tax savings or tax strategy category, I think, is largely geared towards physician owners or solo practitioners, for example. But I think it's one that certainly, regardless of where you're practicing, is at least worth kind of knowing or having an idea about. Just because if you ever switch jobs, you never know what opportunities or kind of things might be helpful to be aware of in negotiating an offer with that employer or with that group. And specifically, they're just looking at tax benefits of whatever the entity itself is that the practice is held or practices under. For solo physicians, for example, looking at switching from a sole pass-through LLC to an S-corp might be something that's at least worth considering to eliminate some potential taxes and to provide some other ancillary benefits as well. Certainly, there's other costs that come with kind of administering an S-corp versus just, a simple LLC, if you will, but certainly one that's kind of at least worth considering. On top of that, a lot of practice owners specifically just being knowledgeable and understanding of the basics of your practice's books. What are you writing off? What's being expensed? What kind of deductions are you taking? What kind of assets of the business, of the practice are being amortized over time? All of these things I think are very helpful to have a very base knowledge in. I'm not saying you need to be a tax accountant by any stretch of the imagination, but certainly having a little bit of that business savvy and an understanding of what things should the practice be taking advantage of from a tax perspective in the present day, and how can that then impact the owners? Certainly there's a lot of benefit to that, and it helps you likely as kind of an ancillary benefit to better understand the business overall. So that is a whirlwind overview of 7 strategies that doctors can take advantage of, or at least consider taking advantage of as it pertains to their tax planning in the context of their overall financial plans. I am Scott Sturgeon. I'm an attorney by training, don't practice law currently, but I'm also a certified financial planner and the senior wealth advisor and owner of Myriad Wealth Partners. We're a fee-only fiduciary financial planning and wealth management practice. We work primarily with physician households, also with business owner households as well, and really in helping to identify and align clients' finances with a lot of the kind of the strategies that we just dictated and kind of talked through. How do we basically implement all of these different strategies and tools to make their finances more efficient? And most importantly, how do we align all of those elements to get clients to where they want to be from a financial perspective, maybe more efficiently, more effectively, so they can really achieve the kind of financial goals they want to achieve. Thank you so much for tuning in. If you're interested or curious about more content like this, I publish a bi-weekly newsletter. It's called Views from the Top, talking about a variety of different financial planning strategies, whether it's estate planning, tax planning, income planning, all that fun stuff. Investing, obviously, is a big component of that. You can subscribe in the description below, or by all means, if you are motivated or moved by various tax planning strategies and it might be helpful to schedule a consultation with me, I'd encourage you to do so. You can click the link in the description for that below as well. Thank you so much for tuning in and have a fantastic day.